You bought an asset. Its price doubled and you sold it to double your money. A good investment or super risky? Most investors think quality as opposed to price decides whether an asset is a good investment. But high-quality assets can be riskier than safer, low-quality assets. Additionally, volatility isn't the risk that investors and capital managers are concerned about. So what are they concerned about? Hi, this is Andrew, and in this video we'll discuss risk intelligence and how to use it to grow a healthy, long-term legacy. Let's get into it. Before we get started, I need to explain that I'm not a certified financial advisor. Neither is my business a certified FCA activity. This video is not advice, legal advice, nor financial advice, but for entertainment purposes only. Yes, this is how we operate our business, but it may not be suitable for you. All investments put your capital at risk. The value of your investments may go up as well as down. Past performance does not guarantee future performance. As always, I implore you to do your own research, DD due diligence, and get your own independent and legal advice. First of all, I should clear up that risk intelligence is not risk avoidance. We need to be aware of the risks and prepare for them. Avoiding risk, on the other hand, means we also avoid taking the advantage of investment opportunities. Understanding risk involves seeing into the future to understand both what may happen, the probability of that happening. But most investors choose to maximize their profits and returns instead. But because ensuring the ability to survive under adverse circumstances is incompatible with maximizing returns in good times, investors must choose between either maximizing profits or surviving for the long term. Warren Buffett famously said, "An investor needs to do very few things right, as long as he avoids big mistakes." FYI, at Dawn, we prioritize long-term survival. There are two kinds of investors: those that don't know and those that don't know they don't know. Most investors are first-level thinkers looking for simple formulas and easy answers. That's not going to succeed. So investors need to be second-level thinkers that know successful investing is the antithesis of simple. We need to actively look for pitfalls and not bet the farm on any investment, no matter how safe the investment appears. This first-level, simple formula thinking leads to unrestrained exuberance, causing bull markets to grow into bubbles and bust, the cycles and pendulums of all markets. Buy low, sell high. That seems obvious. We all know this, but most investors don't follow. When prices are high, investors are rushing to buy, forgetting all prudence and DD. Then, when chaos reigns and assets are in the bargain bin, investors lose all willingness to bear risk and buy, but rush to sell instead. We need to be contrarians, go against the flow. Here are two paths to making lasting returns. Buy low. Buying an asset for less than its value is the most dependable way to make money. The buying process involves estimating the asset's intrinsic value, compare the price to its intrinsic value, and understanding the risks caused by the asset itself and on the rest of your portfolio. to get the asset for lower than its value can be achieved by one of two ways. First, buying at a discount, or second, adding value after acquiring the asset. Dawn works in stage 1 real estate, where adding value is the name of the game. So we only pay below our property's value. Part 2. Do what others won't. The best opportunities and returns are in activities that most others won't do. For example, stage 3 real estate investing is the easiest form of investing, but also offers the lowest returns. Although perceived to be low risk, there are still plenty of risks to your capital. On the other hand, Dawn's activities are in stage 1 real estate, by far the most difficult, most challenging, but most profitable. Check out our video on stage 1. You'll see how difficult and involved it is. Link in the description. Again, we need to be contrarians. Do what the others are not doing. Most people are driven by greed, fear, envy, and other emotions that render objectivity impossible and then open the door to significant mistakes. Uncontrolled exuberance causes bull markets to bubble to bust. Demonthins says it best. Nothing is easier than self-deceit, for what each man wishes, that he also believes to be true. We are all human, so follow this 1, 2, 3 to avoid the human element. 1. Follow the numbers. 2. Get independent expert advice. 3. Stay away from crowds to avoid discussions on speculative talk on fads and market predictions. Accordingly, I get a little frustrated when people ask me on the latest fads, hot investments, and how high the market will go. I have no idea, nor does anyone else. Instead, we need patient opportunism. Wait for those bargains. Don't chase. Counterintuitively, the most professional protocol could be come to work and do nothing, because there's no penalty for doing nothing. Remember that missing a profitable opportunity is better than jumping onto a losing one. We cannot force a project into becoming profitable. As they say, tennis is a winner's game, but investing is a loser's game. In tennis, champions win by hitting winners, but in investing, we win by not hitting losers, i.e., we only need to make sure we don't hit the net. Specifically, in strong bull markets, disciplined investors are willing to accept the risk of not taking enough risk, i.e., don't buy into the latest hot asset. If we patiently keep looking for investment opportunities, we'll find excellent de-risked ones. To create a long-term legacy, we need to use risk intelligence, i.e., we need to use deep second-level thinking to look out for dangers and pitfalls and prepare for the bad times to make sure that we can survive them. Sometimes we may even need to pass up on opportunities and remember to turn off our human element to avoid becoming a motivated buyer and overpay for an investment. Profits come from DD, due diligence, following the numbers, buying low, but not from following our emotions. Thanks for the view, and if you found this useful, please like, share and subscribe. For more details on risk and other areas of real estate investing, check out our other videos. Links in the description. In the comments, Share with us your own risk intelligence and your attitudes to risk.